After yesterday's total meltdown in the face of another overheated inflation number, we need to talk about one of the most important components of inflation that have been going in the right direction for the Fed, oil. Unfortunately, the price of crude jumped 1.57% today, which is the last thing we want to see. But there's good reason to believe that the current bounce may actually turn out to be short-lived, and oil might actually start going lower again. Don't take it from me, though. Tonight, we're going off the charts with the help of Carley Garner. She's a brilliant technician who's the co-founder of DeCarley Trading, the author of Higher Probability Commodity Trading, and our resident commodities expert who predicted the peak in oil months ago when everyone else thought it was going to the moon. For those of you who don't remember, Garner's thesis for most of the year has been that the Russian invasion of Ukraine caused an irrational spike in crude. Russia got hit with tons of sanctions from the West, and Wall Street just assumed that oil would disappear from the market. But that is not actually what happened. It just messed up the global oil supply chain as Russia started selling its barrels to China and India at cut-rate prices. Very few people on Wall Street thought that would happen. Once we realized that there wasn't much of an oil shortage at all, we started worrying about a worldwide slowdown as central bankers raised interest rates to tamp out inflation. The price of crude quickly peaked, plunging from almost $130 to nearly $80 over the course of 6 months. Of course, it's now rebounded to nearly $90, and that's exactly what Garner predicted when she said it would hit the low 80s and then come right back up. And she says this bounce fits into the more gentle uptrend that oil had been going into before the war in Ukraine got rolling. But ever since oil broke down below $100 in July, we've had a number of short-lived rallies, and the buyers have been punished every single time. In the short run, Garner wouldn't be surprised if this oil can keep running for a bit. But longer term, she thinks the bears will win, and the price of crude will head back to a more natural level, which she sees, get this, really at around $60 a barrel. That's the true price. Of course, the bulls have gotten some good news lately. The petro gangsters at OPEC Plus have cut production in order to bolster prices, and now we're hearing that the Biden administration might actually do some buying to replenish the strategic petroleum reserve. They've sold a lot of stuff, a lot of oil when it's much higher. Yeah, I think it'd be a huge mistake if they're worried at all about inflation. Meanwhile, new supply has come online, but not as much as we, let's say, anti-inflationists really are looking for. So why does Garner want to take the bearish side of the trade ultimately here? Remember, 60s ultimately. Well, first, let's check out the seasonal tendencies, which really do matter when you're doing commodity investing. Check out this chart of the historical pattern in West Texas crude. Here you can see how oil tends to trade in a typical year. Normally, it holds up pretty well through early to mid-October, where it tends to peak before coming down hard through the end of the year. Of course, these patterns can only take you so far. Garner's adamant that seasonality is not a trading strategy, but it's worth keeping an eye on. As a result, she wouldn't expect a serious breakdown in crude until next month. At that point, though, you might want to get more cautious. So she's saying history could repeat itself. Not definitely, but it could. Next, let's talk sentiment, as exhibited by the CFTC's weekly Commitments of Traders report, also known as the COT report, okay? This shows you how major players in the futures market are positioned. Take a look at the chart with the Commitments of Traders data down at the bottom, all right? What we care about here is the green line, which shows you the net long or short position size of large speculators, meaning professional money managers. At the moment, these major players are net long just over 200,000 futures contracts, meaning they've cut over 60% of their bullish positions on oil. Garner points out that this is the most negative the large speculators have been on crude since the 2016 lows, which preceded a monster $50 rally as those money managers rebuilt their positions. Again, she does not see a big sell-off happening now because, well, we've had such a liquidation. Negativity in this case is a good sign. It tells Garner that most institutional money managers have liquidated their oil positions already. And that opens the door for a near-term bounce like the one we're seeing right now. Now, let's take a closer look at the monthly chart of West Texas crude, which gives us a nice bird's-eye view of the market. It looks confusing. Bear with me. Garner notes that oil's now fallen back to its old, take a look at this, pre-Russian invasion trading range. Right there, okay? When the war broke out, oil surged higher, but now those gains have been largely repealed. After the invasion, crude broke out above trendline resistance, that's this, in the mid-90s. And now that we've fallen back below that level, Garner thinks it's the ceiling again, currently around $93. That's why we're going to have a hard time right here, she thinks. At the same time, oil's got a compelling floor of support at $80. a floor that we tested last week, and we held. That was significant. And look, even if we've gone back to pre-Ukraine oil markets, you got to remember that things were really looking pretty good for oil in February. Remember, this was a good year that was before the war broke out. Crude was trading at levels that we hadn't seen since prices imploded in 2014, when the fracking explosion caused a worldwide oil glut. For the moment, the uptrend from the bottom in March of 2020 is still intact. I find that pretty positive, almost reassuring. Don't get too comfortable. This is a real rally that was not necessarily engendered by what happened in Ukraine. All right, so how about when we zoom in on the weekly chart? Just like on the monthly, the line in the sand for oil is that floor of support currently at $80. I keep referring to this because that's where Garner said oil would go when oil was here. And what a great call. When the floor holds, we've got the potential for a bounce. Throw in the fact that we've got another 3 or 4 weeks of seasonal strength, and Garner wouldn't be surprised if oil makes it, let's say, way to the low to mid-90s. Might even test the next ceiling of resistance at the $98 to $100 level. And hey, if something big happens, let's say China abandons its ridiculous zero-COVID policy, or we get some political instability in a major oil exporter, she thinks this thing could go to $114. That would be a lot. But she also says that's a low probability event. And if it happens, Garner says you just view it as a last ride. You sell right into it. Why? Because if oil ever breaks down below its floor support of 80, once again, I keep mentioning that number, you can see from the chart that the next potential floor is 60. You want to be in that? I don't want to be in that. And man, when the Federal Reserve is raising rates aggressively in order to stamp out inflation, it's very easy for oil to get crushed. This is not a commodity that thrives during a Fed-mandated recession. Hey, one more negative. Let's take a look at the dollar. Our currency's been incredibly strong, as you know, which is bad news for all commodities because they're denominated in, yes, dollars. Check out the dollars index, which measures its greenback against a basket of foreign currencies. Remember, oil and the dollar tend to settle in the opposite direction about 70% of the time. Pretty strong negative correlation, don't you think? Well, our currency's had a huge run, and it's starting to look overextended. We're seeing tons of money pouring in from overseas, take advantage of our country's rapidly rising interest rates. That said, Garner points out the relative strength index hasn't been making new highs along with the dollar, which is a sign that the rally may be running out of juice, something I believe in. Don't hold your breath, though. Here's the bottom line. The charts, as interpreted by Carley Garner, suggest that oil could run to the mid-90s by early to mid-October. But at that point, she expects it to peak, possibly leading to a big breakdown through the end of the year. If you're worried about inflation, that would be an incredibly positive development, although obviously awful for the oil industry, so don't get too long or complacent about the oil stocks. In fact, we've been trimming back a monster position we had in the oil group for our trust, and we're still doing so into any strength to get back to what we call a regular weighting. Let's go to Eric in Michigan. Eric.
Hey, Jim, this is Eric. I'm just curious, with the rising cost of natural gas, do you still prefer to see alternative energy companies like Generac? Do you think they'll rise within?
I do like Generac, but I've got to tell you, I'd rather go long the position and say to Oncoterra. This has been my favorite because it's 50% natural gas, 50% oil. It was the biggest gainer in the S&P 500 today, so that's not a bad place to be. Let's go to Michael in New York. Michael.
Hey, Jim, thanks for taking my call. I'm a long-time listener and now actually a third-time caller.
Oh, thank you so much for calling in. How you doing?
Yeah, very good. And I actually want to thank you for keeping your word. We spoke last when I introduced you to a company called Ping, you may recall. And you had Andre Dumond on, the CEO, afterwards when the stock was around 16. And I want to thank you for having him on. And I'm not sure if you're aware, but the stock was recently taken out at $28 last month.
Tell me, bro, I was gratified because when we had him on, I liked him very much, as you know. It's been a tough group. Let's talk about another stock.
Yeah.
What are you up to?
Yeah, sure. I'm calling today actually about a streaming service I subscribed to back in June following an announcement with FIFA and the World Cup. Since they hit a July low, it's more than doubled. It's trading well above the 50 and 300-day moving average. And besides just streaming, they just got approved for a sports book in your home state of New Jersey. And last month, they signed an exclusive agreement last month with Ryan Reynolds Production Company for a multi-pack deal. I'm wondering what your thoughts are on Fubo.
Fubo's come down so much that I know it's probably too late to sell, but because it is losing money, sir, I can't recommend it. That's been my rules now for about 6 months, and those rules have been right. Okay, look, the chart suggests that oil could run to the mid-90s by early to mid-October, but at that point, Garner expects a peak, potentially leading to a big breakdown. So you sell. Sure, would be positive about inflation, though, wouldn't it be? Much more mad money. Could the retail REITs be the right choice for your portfolio amid heightened volatility? I'm digging into space. Then I learned a lot during our 2-day stay in Seattle, and I'm recapping the major takeaways from some of the Emerald City's finest companies. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.